Guys, Meta just reported. Look at this. After hours, up $21 per share. That's incredible. Up 13%. And it was up already 2.8% today. Meta has come up nicely off its highs, off its lows. $88 on November 4th. Just 3 months ago, it was $88. Now it's double that. Almost double that. Almost double that in the last. Now, they were expected to make $2.26 per share. They made $1.76. They missed by 50 cents a share. That's a big miss. Huge. If you told me that ahead of time, I'd been like, see you later, Meta.
Bye, Meta. Back to $100.
But revenue, 32.17 versus 31.55 billion. And Mo has the press release.
This is the biggest number, just right off the rip. Facebook reached a milestone of 2 billion daily actives. That is crazy.
2 billion daily active people across Instagram, Facebook, WhatsApp, Oculus, all of their stuff.
Daily active users, 2.96 billion on average for December 2024, 5% increase year over year. Family monthly active users, 3.74 billion, 4% increase year over year. Unbelievable.
Facebook active daily. See, that's the thing. Facebook
is supposed to be dead boomer book.
Yeah.
Growing like crazy.
Well, was anything a decrease? The average price per ad decreased by 22% year over year. That sucks. Oh my God, it's $23, 15% now, Mo. So luckily I exited my 0.3 delta covered calls today going, you know what, I'm going to take Mo's advice. I have this 0.15 covered calls in there still, which I'm probably in the negative on, but now I can write some more covered calls tomorrow on 2/3 of my position. Right. And again, just because I like it doesn't mean you should own it.
So they expect first quarter 2023 total revenue to be in the range of 26 to 28.5 billion. This assumes foreign currency will be approximately 2% headwind. So
what quarter? First quarter?
First quarter.
What are they expecting?
26 to 28.5.
So last year they did in the first quarter 27.91.
Okay, so they're kind of sitting in that same area.
Yeah, but the revenue is down from last year. It was at 33.67. Now it's at 32.17.
Total full year guidance, $89 to $95 billion revenue.
That's low.
What did they do in
118?
Ooh, yeah, but it's normalizing. I mean, that was a big jump.
Yeah, probably because of ads, because of shutdown, all that stuff.
Exactly.
Big number though. They announced a $40 billion stock buyback. And I want everybody to remember, we like stock buybacks as long as the stock is cheap. Example recently, Tesla is super expensive. I saw somebody tweet at our good friend Elon Musk and said, what are you doing with that $23 billion in cash? How about some stock buybacks? That person has no understanding of investing. This is the problem with 99.5% of people out there. So if you're new to the channel, we're going to say things that sound the opposite of what people out there say. That's what a true value investor does. We are actually value investors. We don't just say we are. We aren't the Meet Kevins out there. We aren't all these other hack jobs out there saying they're value investors when really they're not. We truly believe that every investment is the present value of all future cash flow.
Yeah, absolutely.
Now, when a stock to us is down, Mo, do we get excited or we get upset when it goes like this?
I get excited when it does that. I'm not so excited right now, being up 16% almost.
Think about that, guys. Think about that. We own the stock, and I'm upset it's up.
I literally said before the video, before earnings came out, I said, I hope this thing goes down to $88 on the earnings reaction.
Now look at this.
I know.
Up $25.
And I own the stock, but I want to buy more.
I want to buy more. That's exactly it. I want to buy more. Wow, this is incredible.
This is incredible.
So let's look at the 8 pillars here. Now, this 8 pillars, I don't think, Tim, does this include the after hours pricing or just, no, so this only includes the closing price. So the PE and price of free cash flow will increase by 17%. All right, which is not a good thing, but everything else, awesome. And guess what? Their market cap was $400 billion before this increase today. They're doing a $40 billion buyback. They're buying back 1/10 of their shares, guys. 1/10 of their shares, at least.
Yeah.
If they go down to $200 billion, they're buying back a quarter of their shares.
Right.
That's the key here. And for a company like this, look at analyst estimates. Let's go to our analyst estimates in our software.
I love the ROIC too.
What is the ROIC?
Almost 17%.
So guys, why does Mo like that ROIC of 17%?
and they're actually like showing between the ROIC being about 17% and buying back cheap shares. They're showing the management is doing a good job, even though everyone's saying their management sucks.
Yeah. So high ROIC means they get a good return on the money that's invested in the business. It takes less capital. With a high ROIC, it takes less capital for that company to increase the profit of the business. So for example, if one company makes a return on invested capital of 5%, another one at 20%, this company at 5% needs to invest 4 times more money to get the same increase in profit. Would you rather invest in a business that takes less money to grow or more money to grow? It's pretty obvious. Yeah. Now, if you're new to this channel and that sounds confusing, I highly encourage you to subscribe to the channel because you'll learn a ton. We've done over 2,000 videos. We break this down. We look at a company as the present value of all future cash flow. When you buy a stock, you are buying a piece of a business. Once you realize that, your fear will decrease because the more you know, the less you fear. Now, this is analyst estimates from our software here. $8 a share this year is the estimate. It's supposed to increase to 13 in the next 4 years. And revenue, okay, not great, but not terrible. They're expected. So now this revenue estimate for the analysts is wrong.
Yeah, it is.
Because they're guiding at 88 and analysts are saying 124. All the more reason, be cautious with analysts.
Yeah.
Now for me, Facebook Meta is a company I want to own for a very, very long period of time. And this is our stock analyzer tool. Now, before we go into this, what this does is it will explain to you, it'll take your assumptions for the future and decide what to pay. But this software has been very critical for people to get better. Our community is thousands of people. Mo, why don't you explain people more about the software?
Guys, people have been asking for trial runs, and we're doing it just for earnings season. $7 for 7 days. You can come in, click on the link in the description below, $7 for 7 days. Get into the community, use Stock Analyzer tool, use all of the metrics that we're looking at here. Give it a shot. If you like it, you'll get to sign up. And $79 a month, or about $2.50 per day, risk-free, trying the Oracle's VM. If you don't like it after 30 days, email Nick. He'll give you your money back. 18%.
$28 a share.
I thought this company was dead, though.
Well, I still think it's going to go back down at some point.
Too. Guys, I'm texting with somebody right now, and he's like, "This is crazy," and I was like, "Remember, this is a good reaction. It's fine, but remember the revenue's coming down, and there's no stock that is immune to a big pullback in the market. And if you have the thesis of stocks are going to pull back, it's not going to be immune.
Berkshire will pull back.
Everything will pull back. So don't feel like, oh, I missed it. It's $181 now. It was $80 a couple of months ago. Just chill out. Don't have.
And by the way, maybe you never buy 88 again. Maybe you buy lower than 88. Maybe you buy at 100. Maybe you buy 120.
Who knows?
The point is, the better you understand about the company, the more likely you are to pull the trigger when the price goes lower. Because if you don't understand what you're buying, if you don't understand you're buying a piece of a business, all you care about where the stock price is going, why would you buy more as it goes lower? So, the Stock Analyzer tool. This has been used over 1.3 million times in 2022 by our users. Thousands and thousands of users have used this thing over 1.3 million times. Now remember, it doesn't factor in the balance sheet. It looks at low, middle, and high estimates of revenue growth, profit margin, free cash flow margin. Then we assign a PE and price of free cash flow to basically determine the value of the business in the future and put in our desired return. The higher our assumptions, the higher desired return, because that's basically our margin of safety. It'll compute it out quickly and tell you what price to pay based on your assumptions. So Mo's going to do a 10-year analysis.
Okay.
All right. Estimate. So what are your numbers then?
So revenue side, 6, 9, and 12. And high side 12 because of the metaverse. If it takes off, if it works out. Let's call it that. Profit margin, same thing. I mean, 25% I think is very reasonable.
Yeah.
33 if they crush it in the metaverse.
Yeah, and they have very high gross margins.
Exactly.
So.
I did the same thing for free cash flow margin because it's very similar. Now, PE, 14, 16, 18.
See, I would have gone 15, 16, 17.
See, I'm always tossing that one back and forth. Same for price to free cash flow. Return, 11, 13, 15, 15. If this works out, I need a little bit.
I still would have done 12, 14, 16.
Oh, okay.
Because I still think 6% is going to be
a little high?
On 10 years.
10 years.
Yeah, that's what I think. But what numbers did you get? So the stock's currently 180.
I'm sure we're going to see a lot of green.
Oh, wow.
$183 on the low end, $326 on the high end, and about, call it $250 in the middle.
And I think for a long time, I've been feeling like 250 is
price.
is the price for me for Meta. So
Yeah.
based on this, one, I like the fact that they're going to buy back shares. If Mo's numbers are correct, this is a buy. Doesn't mean go out and buy it because that's what that said.
That doesn't mean they're correct.
And it doesn't mean they're correct. Remember, when you're making, that's what the art of investing is. You're making this wide range. We do a low, middle, and high. Over a 10-year period, the difference of 6 versus 12% revenue is literally double the amount.
Right.
Right? So you have to remember that there's a lot of unknowns there. And that's why we like to have margin of safety. So if you like this process, if this makes sense to you, you need to subscribe to the channel.
Apple, Google, Amazon tomorrow, same time.
Thank you.